Good afternoon, everyone. I hope that you had nice coffee break and coming back with a refreshed spirit and mindset and so on. Because we've been slowly moving into the finance part, and then now it's we are gonna deeper dive into the finance. So thanks for the kind introduction. My name is Ho Young-in, and I'm a faculty member of Civil and Environmental Engineering at the Korea Advanced Institute for Science and Technology. Today, I'm going to present a series of my research on utilizing sustainability factors for investment strategy. So I've been thinking, like how I want to open up my stage, and then I want to talk about, I want to walk through what is happening in the landscape of sustainable finance and investing, because it is changing so rapidly, like faster than ever. And then, the challenges or debates and the discussion that we are facing today is the subject of my research. So thanks to my previous speakers, very renowned scholars, I have less time to go over this slide. So, as we see, climate change is happening, and then global is committing to, move to the net zero. We've been talking a lot about the funding gap. To move to the net zero, it's not for free. We need a lot of investment. So for decades, we've been talking about where's the money. As I said, this landscape is changing very fast. So these days, what we are seeing is, more investment capital is committing to support this net zero transition. So we are seeing money. It's coming into this field. But then, we are now curious where this money is being spent for. So we want to make sure that this capital is actually mobilized to where we need it for. So this is really important question that we are facing now. And then this is more about the alignment. So when the capital is becoming available, how can we align those interested capitals into the right project, assets, companies, and portfolios, and so on. Investors are facing challenges, and then I think those are the three big challenges they always talk about. And then this is the three big topics for my own research as well. So lack of standards, the lack of accessibility and availability of data, and also the performance concern. You might think that those three are a little bit of different topics, but it is indeed connected. So because we need to have good information, good data, to really perform better in the investment practices, and then for that we need regulations and standards and the disclosures and so on. So those are the three big topics. And for today, I'm going to talk a little bit more about the performance. However, I want to end it up with discussing a little bit more on the data side. So what type of performance we are talking about? We are talking about the financial performance of the investment strategy considering sustainability factors. And this financial performance of sustainability investing is very important for the investors who has the fiduciary duties, because they are obliged to maximize the shareholders' wealth. So if you are considering sustainability factor and that is not really giving you the optimal output, then you cannot really do this, because by considering this sustainability factors in your decision making is actually breaching your obligations. So this is a pretty recent definition that is done by PRI and in collaboration with the CFA Institute. And then they define what is sustainability integration is for. So I'm going to just read it. So sustainability integration, ESG, sustainability. I know there's a difference, but I'm going to just do it as a sustainability. Ongoing consideration of the sustainability factors within the investment analysis and decision-making process, with the aim to improve risk-adjusted return. So, there are many other sustainable investment strategies, but, the PRI actually defines sustainability integration is actually aiming for risk-adjusted return. Then the financial compatibility, we now understand the financial compatibility of this, sustainability, sustainable finance is very important. Then how are we doing in terms of academic research? So this is my forthcoming research that actually reviewed 47 years of sustainability research, and then reviewing like 26,000 academic articles on sustainability. I'm sorry about the bad resolution, but this is interesting how financial performance, the keywords financial performance within the network of sustainability is linked to. So, it's only less than 15 years of time span, and then it's a lot of dynamics is happening. So from 2006 and 2011, the circle on the right is the financial performance, and then the top is environmental performance and sustainability. And as you see, the keywords are in the edge of the network, and it's small by weight, and it is distanced. In the middle, I'm sorry about the bad resolution. One on the bottom is, again, financial performance. And then on the middle is sustainability. On the right, I think it is environmental sustainability. On the right is environmental performance. So as you see, financial performance is slightly moving toward the center, and also it is getting closer to environmental performance. Recent years, what we are seeing is that financial performance is also connected to other keywords, for example, sustainability reporting and disclosure. So, as I said, financial performance is related to not only the environmental sustainability, but also the data and the reporting standards and everything. However, there are many empirical studies that try to really clarify the relationship between the financial performance and environmental performance of the companies. But unfortunately, as of today, we are having still a mixed result. And there are many meta studies that is looking at those empirical studies, but their conclusion is, indeed, empirical evidence on this relationship is mixed. So that's why we are not really, the academic research is not really serving the practitioners' concern, who really concerned about the financial compatibility of sustainable finance. And what is more important is that, the impact mechanism, exploring how a firm's environmental sustainability can affect its value is still in debate. So those are the ones that, I think the academic literature should serve better. So I went to deeper investigation on why we are having this discrepancy within the empirical analysis. And I thought two are the major concerns. One is data. The second is methodology. So data, we are talking about data a lot. And then Luis has a really good, proceeding presentation on the data part. I'm gonna touch upon again on the data side. So on the left, we are having divergent sustainability ratings. Depends on which source that you are using, that you are getting the data on corporate environmental sustainability. You are having totally different figures. So this is the figure from Credit Suisse's report, and one on the top left is a Facebook. And then different color dot is representing different data sources. And as you see, that actually diverges from the 0 to 100. So you cannot really tell that, whether the Facebook is doing environmentally sustainable or not by having multiple data sources. And the other problem is also the aggregation, the conventional practice of data aggregation. So usually, we try to just add up environmental, social, and governance data put together to get net ESG score, which doesn't give you any information about the company. So those are the one problem that is coming from diverging sustainability data. So in my latest research, I dive deep into the carbon data because I thought, okay, carbon, like a corporate carbon performance is some part that is more heavily regulated. And it's been like reported by mandatory basis or also voluntary basis and so on. So what I did is just simple correlation. Heat map, just look at all the data points that is coming from different data sources on carbon emission, and then as you see here, they are not converging at all. So even the carbon data is like that, and the implication. So even if the data is based on the carbon emission, when it's unscaled or scaled by something, is giving you very different implications. But I know that this cloud understands like a very the subtle distance of those like measures and metrics, but unfortunately it's not really well adopted or well clarified in many other studies. So those are the concerns about the data. The methodology is another cause of the divergent. So we look at those historical empirical analysis on environmental performance and financial performance, and then those are the three key methodology that previous researchers are using: event study, regression analysis, and portfolio analysis. Event study is more direct. However, it's hard to generalize the findings into the general cases. Regression analysis is good, but still, we are subject to the endogenous issues. Portfolio analysis is something that is frequently used these days, but again, we are having some problems in building good consensus. What it is when you are building portfolio, what investment strategy that you use. Did you do just negative screening, just excluding some sectors in your portfolio and then run it? Or did you do, like a winning or losing type of thing and then doing the long shot? That type of clarification about the investment strategy in your data research setup should be clarified. And then the last part is theoretical foundation. So once you find, whatever the statistically significant result and so on, you need to be able to explain that with the support from, with the connection with, the theoretical foundation. But this is something missing, and also people, many of, green products or services these days are trying to promote their products by showing their past performance. But we have to be very clear on past performance is past performance. This is not really telling you what's going to be happening in the future performance. So this type of thing is something that, linking back to the theoretical foundation would help. Yeah, so those are the, the knowledge gap that I was seeing. And then in this research, I try to clarify those issues as much as possible and then try to answer what is the risk and return relationship on low carbon investment portfolios. And then we try to also find out what are the empirical relations between corporate carbon efficiency and stock market performance. So in this research, we try to investigate three big research questions. So the first thing is whether there will be return if I consider carbon efficiency of the company in building my portfolio. This is important because, if there's no return, then, the low carbon investing is something that is really attractive to the private sector. So that one was the first question. But the second question is, once you see that return, that we want to understand whether this return is coming from the risk compensation or something else. This is really important for the different type of investors. If this is really coming from the just you are taking more risk, thereby you are getting more return, then maybe risk-taking investors will come into the low carbon investing. But if it is something abnormal, then we can go more forward. This is great, okay? It's giving you some abnormal return. Why is that so? That is leading to the third question. What is the characteristic of those firms who are carbon efficient and thereby why they are generating higher performance. So those are the three key research questions that I try to investigate in this research. So let me simply go through the research design. So we analyzed 1,715 public US companies from 2005 to 2018. And then we build a portfolio using firm-level carbon intensity. So basically, it's absolute carbon emission divided by the revenue. This is actually a very consistent measure of how much carbon emission the company needs to generate in order to generate a unit of revenue. And then, we did the long-short investment strategies. Basically, we are selling carbon-inefficient stocks and then buying carbon-efficient stocks. And then we do it every month. There's many different ways to build this EMI portfolio. This, the factor mimicking portfolio, we name it as the EMI portfolio. There's one simple way is just single sorted portfolio based on the carbon intensity. But there could be also the double sorted portfolios, also considering the value factors and the size factors. The second research design was using the factor model, we ran the GRS test. So we want to price, if there's a return, we want to price whether these returns are coming from the traditional risk factors or something abnormal. So on the right, this is a GRS test equations. The left side of the equation is the return on our EMI portfolio. And then right side of the equation, we just bumped into all those traditional risk factors, the market, size, value, momentum, profitability, and investment. So in this equation, if the alpha, the intercept, is positive and statistically significant, it suggests that the return on our EMI portfolio cannot be priced by those risk factors. That means one can earn extra returns after accounting for those conventional risk factors. The third one is we also try to look at what are the empirical relations between the firm's carbon efficiency and their other firm's characteristic variables. So that include financial performance and corporate governance. Okay, that was the research setup, and this is what we find. So this is what we find from tracking the returns. On the right side, we track the average monthly return on our EMI portfolio. And then over the entire period, we were seeing that carbon efficient firm, like a top 30% of carbon efficient firm were outperforming carbon inefficient firm. But what was more interesting was, this difference become more larger and statistically significant after 2009. And if you are seeing on the figure in the middle, which is a cumulative return on the EMI portfolio, that this vertical line is exactly the 2009 time period, and then the slope is changing. So that means carbon efficient firm stocks start to outperform carbon inefficient firm stocks from 2009 time. We also ran the Sharpe ratio on the right, and then as you see, EMI portfolios are actually more attractive than other factor mimicking portfolios, especially during the later time. And then as you see here, it's not coming from the average return, but it's more about the lower standard deviation compared to other factor mimicking portfolio, which means that EMI portfolio can be less volatile. Okay, the finding too. Okay, it's kind of clear that we are actually getting a positive and statistically return on EMI portfolio. Now this is a result of our GRS test on three-factor, CAPM, three-factor plus momentum, and 5 factors. And as I highlight the alphas become positive and statistically significant after 2009. So, it kind of comes with, our observation at the beginning. So, and then, the size of this abnormal return, alpha, is ranging from 3.5 to 5.4% per annum. So, which is pretty significant. This is not the return on the investment, on the portfolio. This is the risk-adjusted return. The third part is the empirical analysis on the characteristic of carbon-efficient firms. And then what we find is carbon-efficient firms tend to be good firms in terms of financial performance and financial stability and corporate governance. Okay, so this is great. So what? We have to talk about the implication. We were curious about whether investors during the sample period were caring about, how diligent and how well the company is reducing their carbon and being carbon efficient. And then what we did is, we rebuilt our EMI portfolio using change of the carbon efficiency, and then, try to track, whether, we are seeing the similar pattern of our conventional ESG portfolio. And we were not able to see any of the return patterns on EMI portfolio based on the change of the carbon efficiency. So that means, we can assume that investors were not really caring about, how fast or how diligent the company is actually improving their carbon efficiency during that sample period. There could be other macroeconomic factors that might affect our observation. So we ran some other testing, for example, the oil market fluctuation. So what we did is, we try to look at, the change in the oil price, whether that is any impact on our observation. And then this is a 18-month window rolling correlation coefficient, and it is actually swinging in between -1 to 1, which means it's not really correlated. And the third part was interesting because, when I was conducting this research, I was really excited about the result output that we find. But, I would just want to really know, what happened in 2009 and after. So I was actually talking to the asset manager in Wall Street and hey, what happened, in 2009? And what they said is there's an unconventional monetary policy after the global financial crisis, which means very low interest rate. So what happened to the financial market is actually they are pushing the equity bond investors from the bond market and getting into the equity market. However, those investors' preferences were not changing. So they were actually looking for stable and high-paying, high dividend-paying industries. So what we did is we excluded those 4 industries and try to see whether EMI portfolio has a similar patterns, and then we find similar patterns. So not only those industries that were affected by the unconventional monetary policy during that time was also showing the outperformance patterns. Okay, here. Then how can you explain those abnormal return? So it will be easy to say if I don't see anything, then and then I can go with oh, okay, there's a fund level panel regression analysis, and then there's a positive relationship between the carbon intensity and emission, or carbon emission and returns and so on. Then high risk, high return, theory is just working perfectly here, but here, a farm-level panel regression can be less robust because the individual stocks are very volatile, and also the effect of the controlling variables are different. So here, we still get the portfolio analysis. The portfolio analysis can address some of the volatility issues from the farm-level panel regression. And then this is the very interesting study that I want to also show from my research is that Pastor's research from the University of Chicago, and then what they find is, okay, we are also seeing these positive alphas on something like EMI portfolios, And then by this time, what has happened is, there's a unexpected, however, sufficient inflow of the investment capitals into the carbon efficient firms. So that was why we were seeing the green returns. So, we are still in the process of, finding the good financial theoretical foundation to explain our observation. So there's more questions pending than, we are doing the further research. So the question that I'm getting always from the investors crowd is that whether this outperformance patterns will persist for the long term. As I said, we don't know. I will be very much warning to say, past performance is past performance. It's not being used for the predicting for the future performance. But we can, still hold and then accumulate more data and then look for this, pattern observation. And the second part is, it will be also interesting to see if, this outperformance patterns will hold in different countries, especially the emerging market countries. And then the third one is, in our research, we were using carbon intensity, but maybe we can use some different data of the company, and then whether that is actually giving you better performance. This is leading to the last part of my presentation, and also the part that I want to call for the collaboration with the ADIA network is about the data. So as I said at the beginning of my presentation, the landscape is changing so fast. And then now we are talking about money is there. But then how can we use data to better measure of the sustainability levels and also evaluate the impact that you are generating? So we are now entering into really interesting period. However, I think there's a lot more to do in this, getting more reliable data. So here is one example. So this is, a simple visualization of carbon data value chain that I just drew. So data is being generated from the companies. They do sustainability, decarbonization stuffs, and then they provide the data, by self-reported or, being captured by the third party or whatever. And then this data is being collected and then aggregated, re-engineered, and then being utilized and consumed by the end users, investors, insurance companies, consumers, and policymakers, and so on. What we are seeing is, this aggregation part is growing fast. We are seeing a ESG data market is growing, and then, every day we are seeing M&A news and everything. But actually, where this data is coming from is companies. How are we doing about the capacity building of those, companies who are generating and providing data to serve this market? And also, how about this end? The end users, even if we are getting more and more data, if we are not sure about how this data is telling you, what are the implications and how they can be used, then I think, the data has less value. So, we have to really think about how can we, build this entire data value chain more robust and comprehensive. And then, our goal is try to generate reliable, transparent, and comparable data. Then what are the blind spots? Where we can, discuss about the collaboration and work more on too. The first part is the SMEs, When I was doing another research on the data value chain, then many ESG data companies are saying, oh, big companies, they're doing really well. They already have the internal capacity and so on, so no problem. But when you are talking to the SMEs, they are saying we don't have skills, we don't have time, we don't have money. So, but more and more, those SMEs are connected, and then as we care about the global supply chain of the carbon, this SME is becoming more important. Then how can we bring those SMEs into this area? So that's one thing. Second is this data value chain is interesting. At the same time, we are seeing the globalization of the data value chain, but it's decentralized. What it means is, at the end, like a data market from, for example, Korea, and then from European country will connect it. But how this data market shapes and structures are very different. So this is one snapshot of my other research, that this is how the data supply chains look like. And then this blue spots are where the public sector is dominant. When you're looking at the market-driven countries' structure, then only the regulator is where the public sector is dominant, whereas other sectors are private. So, how can you really, incorporate those, geographical differences when we are talking about global data value chain? The last part is, alternative data. I mean, we are getting more and more data. Like, what does it mean? What are the implications? How can we use this? We need more kind, specified, detailed guidance on how those alternative data can be utilized for sustainable finance. Okay, this is about it, and thanks for listening. And I hope that was giving you a little insight. Thanks.